Are you ready? Awesome. All right. Let's call the meeting to order. Um, we'll start with the minutes. Is there a motion to approve the minutes?
That we approve the minutes.
Thank you. Is there a second? Excellent. Any discussion, corrections, anything? All in favor?
Aye.
Any opposed? Great. All right. Do we have to, is Jonathan up or do we have to do anything else?
I don't think so. I think he can come on up and just
Yeah.
introduce himself.
Jonathan Bryant, Marquette Associates. Good evening, everyone. If you go ahead and open up your books, there's a cover page and then a soft cover page behind it, table of contents. Shows you what we have in the book today. So we have your second quarter performance report, a asset allocation sheet with some rebalancing recommendations, as well as the benefit index calculation, the cushion that you have with that you could take out of principal right now. We have a fixed income core plus search, which is going to be the primary agenda item after the performance report. And then we also threw in the high yield search from the prior meeting to just in case we wanted to revisit it. I don't think we probably will. But anyways, let's hop in. On the first page, you'll see our invite for the 2025 Investment Symposium. It'll be in Chicago. September 26th at the Union League Club. I handed out an updated version of that sheet it has everything on it. It has our agenda, how to book yourself in if you want to go in person. We also are going to be live streaming it. And then I think also, if you can't make either, they'll post it to YouTube as well. So we had that on hiatus last year and we're bringing it back this year. With that, we have a Marquette update. For sake of time, we'll go ahead and skip that. Then we have a second quarter 2025 market environment. It's 50 pages. I was going to say, we probably don't need to go through it.
Hopefully you read through it or at least look through it. Does anybody have any questions about it? Anybody?
No.
Okay.
The
All right.
biggest news was that payrolls print last Friday, that big revision downward, and how that shifted rate cut expectations. Looking like more rate cuts now because of that, but we'll see.
We'll see.
Yeah. That's what I just feel like I've been saying that for 4 years now. We'll see. Go ahead and flip to Exhibit 1. That's the quarterly report. There you go. Jennifer's got it. And if you flip ahead to page 1, this is your manager status page. This is where we highlight any managers if there's any issues with them. As you can see, they're all in compliance here, so no issues there. But just for your minutes, just know that they're all in compliance. Flip ahead a few more pages to page 5, I think. I flipped ahead too much. Page 4 and 5. So this is your market value page. You ended the quarter with $23,827,901. And to the right of that, you see a percent of portfolio column. That is the current weighting for the investments compared to the total value of the fund as of the date of the report. Compare that to the column to the right of that one, that your policy percent column. Those are your target weightings. So you see pretty close to target weightings, no real issues there as of the end of June. Flip ahead to page 6. Yeah, 6 shows you how your plan looks compared to other public defined benefit plans. Won't spend any time there. Page 7 shows you the historical asset allocation, how it's changed over time, last 4 years. Page 8, I will spend a brief moment on. This page shows you the market value history of the plan going back 10 years, and then summary of cash flows below that. You see for the quarter, plan started out with about $22.4 million, had negative cash flow of about $45,000 out, and had positive investment change, so appreciation in assets and income of just under $1.5 million. That's how we arrive at that 23.8 million roughly for the end of the quarter. You see the same information for timeframes going back, and you see that overall your net investment change has well outpaced the negative cash flow the plan has. So even though you have money flowing out on one side, at least your assets are keeping up well ahead of that cash flow out. Skip ahead a few more pages to page 12. And we'll dive right into performance here. So the plan for the quarter was ahead of its benchmark, had a return of 6.7%, just slightly ahead of the benchmark, ranked in the middle of its universe. Year to date, also slightly ahead with a return of 6.4%, again, ranked in the middle of its universe. Going back in time, returns and rankings are a bit mixed. 1 year and 3 years, you're a bit behind. 5 years are slightly ahead of the benchmark. 7 years slightly behind. 10 years right on the money at 7.3 versus 7.3 for the benchmark. Since inception, we are behind. Rankings typically are mid to low, but I will mention that your actuarial target rate of return is 7%, and you have achieved that for most time frames except for the since inception period. Looking under the hood, your fixed income composite and the underlying managers there. Overall, your fixed income composite has done well. It's outperformed for pretty much all time frames except slightly behind year to date and just matching the benchmark since inception. Rankings are mixed, mostly middle to low, with a more in the short term. You do have some high rankings for the 3-month and 3-year periods. Principal core fixed income is your core manager. They have outperformed all time frames except for 7 years. They're just matching for that time frame. Near term rankings are high, typically in the top 20% of their universe. Long term, medium to long term rankings are typically mid to low. Then you have your principal core plus bond fund, and this is the one that we're going to discuss more in detail here in a bit. They had a pretty good quarter. They're slightly ahead year to date, but for 1 year and 3 years, you see they had pretty rough returns there and ranked really low in their universe for the core plus fixed income universe. And rankings typically in the long term are low, even though they are ahead of their benchmark for those time frames. Principal high yield, this is the one we discussed at the prior meeting. So initially you were forced into what they called their high income fund. So you didn't really have a choice. That was the only high yield option you had with Principal. They decided to discontinue that fund and actually put you in the better version of the fund, which is called the high yield fund. And at the meeting, we discussed it at length and decided, this is actually a top pick for Marquette clients. We have quite a few clients in that fund, and performance is pretty good for them. Just we don't have the long-term performance data for them since they just made that change back in March. Slightly behind for the quarter and behind since inception, but it's only a few months worth of data, so not really gonna fault them for that. Aristotle Pacific is your floating rate bank loan manager. They are ahead for the quarter, behind for year to date in 1 year, and since inception just matching the benchmark, but ranked high long term. So they've overall had a good start. We got them back in September of 2022, so we'll get some more long-term performance data here at the end of next quarter, or this quarter, I should say. Page 13, U.S. equities. Overall, U.S. equity composite has underperformed its benchmark of the Russell 3000. Rankings are mixed, typically in the mid to low areas, though. It's been that slug that we have in mid cap and small cap that's hurt us the most in the long term. Unfortunately, small cap hurt us this time around. But looking under the hood, Vanguard, S&P 500 index funds done really well. Typically ranked high, matching its index like it's supposed to. Active management has just not done a good job in large cap in the large cap space. So indexing's been really the key there. Vanguard mid cap has done really well, actually. Had a really good start. For 1 year, it's actually ahead of large cap and ranked typically in the top 25% of its universe for all the timeframes we have so far. The iShares fund, unfortunately, it has a bit of a quality bias in the small cap space. So if you're in the Russell 2000, there's more junk in there, more unprofitable companies. Unfortunately, that quality bias did cost us a bit in the small cap space. Even though it's matching the index, I'm just saying compared to other small cap indexes, it hasn't done as well since we brought them bond back in April 2024. Long term, though, you'd expect that to change. Page 14, non-US equity composite. Short term, it's done well. It's ahead for the quarter, ahead for 1 year. Long term, underperforming. I'd attribute most of that long term underperformance to that slug we have in emerging markets. And we have a lot of clients. Most of our clients do have a designated exposure to emerging markets, and that has hurt them as well. Long term, you'd expect that to change, but overall, non-US equities have done well this year. US equities were the belle of the ball in 23 and 24. I think at the start of this year, we mentioned, 20% plus returns in the S&P. Typically don't go 3 years in a row. We'll see this year. But non-US equities have kind of taken up the mantle of being one of the best performing asset classes so far this year. Various reasons, capital flight out of the US due to the volatility with the current admin, stimulus proposed by European countries for defense spending, and currency effect as well. So, weakening of the US dollar has lifted all these non-US equity managers. Vanguard total international funds doing well overall, but rankings are typically mid to low. Vanguard all world ex-US small cap, similar story, doing well but ranked low overall. Vanguard emerging markets, and this is really what's dragged down the non-US equity composite, unfortunately. Matching the benchmark for the most part, but typically ranked mid to low as well. Next, you have real estate, and you just have one manager there as principal, and they had a really excellent quarter of 1.8% versus 0.8 for the benchmark. That's really helped their long-term numbers, just matching year to date, a little bit behind for 1 year, but those long-term numbers really improved. They're typically ahead for the most part, except since inception where they are just matching the benchmark. Then private equity, we don't have the benchmark return yet for the second quarter. It's typically lagged, quite lagged. But overall, you look at the long-term numbers there for Partners Group, and they're doing well ahead of the benchmark for pretty much every long-term time frame. With that, I'll skip ahead a few pages to page 20. Always like to look at the plan from a risk return standpoint. This is a 5-year time frame. Plan is the blue square, benchmark is the black diamond, the median of the universe is the middle of the crosshairs. You see the plan is ahead of the benchmark from a return perspective, but behind the median of the universe. But it has less standard deviation or volatility than the benchmark and the median of the universe. So overall, from a risk return standpoint, not doing bad. Page 21, I do want to spend a moment here. These are your fees for all your managers, and we compile them at the bottom there and in the blue rows. And we estimate you're paying your managers about $90,488 annually. That's based on the ending market value for all these managers on June 30th. That equates to an expense ratio of 38 basis points, just under 0.4%. And unfortunately, that is higher than what we would expect you all to be paying, which is the median of about 35 basis points. And unfortunately, I have to point the finger primarily to principal. The vehicles that you guys have available to you are typically at a higher expense ratio than alternatives in those spaces. For instance, the core fund is about 1.6 times more expensive than the median. The core plus fund is almost 2.3 times more expensive than the median. And the high yield fund is a little more reasonable. It's only 1.3 times more expensive. So unfortunately, those are hurting us in the fee categories. Partners Group is the only one that's not a principal fund that is higher than the median. And then we also put down our fee and then your custodial fee at Regions and total that up at the bottom as well. Any questions on the quarterly report?
I have one sort of rhetorical that, with all your brilliant minds at Marquette, you did make the comment that small cap, historically will come back, that type of thing.
Mm-hmm.
Do you really think it's going to come back? Because, in today's world, the internet companies, these IPOs, they're not coming out as small caps and growing.
Mm-hmm.
And if it's a private company and it's small and he's doing well, the behemoths are buying them. So there's a lot of, pardon my French, crap in the small cap. And will that change? So you don't have to answer that today. You can give us your opinion, but
Yeah,
I'd like to hear.
It's a good question. It seems small cap really, really started struggling with interest rates. And that could be because there's a lot of I call them zombie companies. They just perpetually exist, but don't really make much of a profit or grow. It's a good question. Our model suggests that it will, but models suggest a lot of things.
Right.
So
That's why I
yeah,
say it's your model, but anyway,
No,
it's more rhetorical, but
tough question. Yeah. We'll see. All right. Well, with that, I'll flip to exhibit 2. We just have a bunch of like characteristics pages after that, so don't want to spend the time to go through all those, but it's there for your information if you need it. So this one doesn't have a page number, but it's your asset allocation sheet. There you go. So what this page shows is values for all your investments as of the end of July, because we kind of marry this with the benefit index calculation, because that's when they give it to us as of is the end of the month. So we do have a slight rebalancing recommendation here, primarily to replenish your principal core fixed income fund, because that's where they pull the benefits out of. So there's quite a bit of negative cash flow out of that investment. So recommendation here is, well, I'll tell you real quick though. Overall, the fund is near its targets for its asset classes. The fund, as of the end of July 31st, had just above $23.8 million. August 1st might have changed that a little bit, but it looks like things have probably come back. But anyways, here's the recommendation. So we recommend pulling $25,000 from the Vanguard S&P 500 fund, $15,000 from the Vanguard Mid Cap Fund, contribute $50,000 to iShares Core S&P Small Cap Fund, take $25,000 out of the Vanguard Total International Fund, $20,000 out of the Vanguard Emerging Markets Fund, $25,000 out of the Vanguard International Small Cap Fund, contribute $150,000 to the Principal Core Fixed Income Fund, and then take $90,000 out of the Fidelity cash. That's the cash that's sitting at Regions Bank in a money market fund, and that's a lot of residual from the final payout we received from Principal Real Estate. Oh,
I noticed the numbers on real estate are pretty much at close to 5%. Have we
Mhm.
gotten everything we need
yeah,
out of
it's
there?
all out.
It's all done.
Yep,
Okay.
just need approval. Sorry,
Sorry.
a motion, I guess.
Is there a motion to approve Jonathan's recommendations?
Motion to approve Jonathan's recommendations.
Right. Any discussion, questions? Anything?
How strongly do you feel about the small cap?
Not enough to make changes to spend time at, I mean, it's at 6% right now, I believe,
7%.
7%. I don't think it's
6%.
6%. I don't think it's worth a discussion. I mean, I don't think it's worth spending a lot of time right now. I think it's a discussion to have. That's why I said it was sort of rhetorical, that it's a discussion in the future that if it
Yeah,
continues to
question,
do what it
does
does,
continue
it's,
to underperform?
Right.
Yeah.
what do you do about it?
My only question about that
Yeah.
is, do you really want to fill that space with new dollars?
Well, I think I would say yes, because you've got to stick to your models at this time. Is what I
Yeah.
would say.
I think we just approved that allocation earlier this year.
Yeah.
Yeah.
So, I mean, I
just wanted to
agree.
ask the question.
No, it's a
because
good
we're not-
question. But I don't think we should, it's the time, I think we got to stay
Yeah.
where we are.
I would think when interest rates, if interest rates finally start coming down, you'll see small caps probably, at least for a period, outperform.
Could be. I
Yeah.
hope so.
That's my take, at least.
Okay. I hope you're right.
Yeah, I hope I am too.
Good question. Anything else? All right. All in favor?
All right.
You need a
Oh,
second.
We did.
Who seconded it?
I made a motion.
Oh, I thought Alan made I made the motion to approve, and Jonathan and Mike, I made the motion to approve.
Thought you asked for the motion.
You asked for the-
You asked for the motion.
Oh, I'm sorry. I apologize. Okay. then
So Ted made the motion.
I made I'll make the motion. Michael will. I
Second.
apologize. I thought I made the motion.
All right.
All right.
All good. We'll,
And then all in favor?
Aye.
okay.
Any opposed? Excellent.
Right.
Sorry, Jennifer.
That's okay.
And with that, if you just flip one more page, it's the one on behind the rebalance sheet there. So as we've been discussing pretty much every meeting is, how do we get money out of principal? What's the smart way, smart places to put it? Initially, we were thinking high yield because we were in a fund that wasn't doing very well. And then right before the prior meeting, principal said, oh, we're going to discontinue this one and put you in our good high yield fund. So took a lot of the punch out of that search, as Tom would say. So we come back with a core plus search. And what this page shows is it shows you the investments and with principal and the the liquidity / volatility factor, they're each one's multiplied by to arrive at the present value of it, or the value they want you to keep there based on the benefit index calculation they give us.
So they put us in a fund that you would rather have us in, correct?
Yeah.
Was that fund not available all along?
Yeah, they gave you a very limited universe at Principal, and the one that you guys had access to was the crappy one that they discontinued.
I just want to make note of that.
I know.
I want to make note of that on the record so
Yeah.
that they're limiting us on funds
Yeah,
and they're requiring us to have a certain amount in their funds. And I think that there's something there that is inappropriate.
yeah.
I just want to put on record.
Mm.
What we do with Baz Tony.
Allowing access. Different funds, right?
Yeah, we've just seen what's available. But what's on the sheet is well, this is the calculation that they give us, I should say. It's not really what's available to you guys. It's kind of their universe in that on their
Mhm.
platform. But I guess depending on the fund, they only allow you certain choices, which is unfortunate, but
Do you see any others in other places? They're originally contractually, here's what we're all gonna offer you. They go back and supposed to help that.
yeah.
Usually on these type of plans, they have their list for just these plans, and unless they open it up to put you in a different contract, they
Mhm.
don't offer other plans. I've dealt with
Yeah.
this dealing with John Hancock and right now with
Mm.
older plans. The same thing, and they're the same as,
Yeah, they kind of got
Principal.
their fangs in long
Yeah.
ago, and it's just something we got to
and they don't like to change because, yeah. Yeah.
Yeah, well, you mean like outside of Principal's platform? So this one was the one initially, start of the year, it was in the fund that we didn't want to be in.
Mhm.
And that's why we came with a search at the prior meeting to try to get us out of it and get into something else. But getting us switched to that, there really wasn't much value in switching at that point. So
Well, and not to get ahead of you, but with the real estate redemption, I've never seen the cushion over $2 million. So
Mm.
now we have some flexibility to leave Principal with this Core Plus or other high yield funds, right?
mhm. Yeah, we have a lot more flexibility now. The fund overall, we've had appreciation
Mhm.
in the fixed income assets there, so that's provided a lot more cushion. I wouldn't. So the recommendation that what Tom and I discussed is we were going to recommend taking 1 million from the Core Plus fund and choosing another Core Plus manager to give that to outside of Principal. So it would be at Regions Bank. That to me seems to be the most bang for our buck at this point in time. And as time goes on, we can see how that cushion changes. And if we get over, 1.2 million or 1 million again, we can start pulling some more out and shifting more toward that Core Plus fund outside of Principal.
Do you want to go over the Core Plus options that you
Yeah.
put together?
Yeah, we can. I just
Okay.
wanted to spend a moment here
Yeah.
because it shows you that cushion.
Uh-huh.
So we could do 1 million, we could do 1.2 or 1.3. It kind of depends on your comfort level. But we will see our options here in Exhibit 3. Now you flip to page 2 of Exhibit 3, you'll see our options here. So we included Principal for comparison purposes. We're not recommending. You're going to have to keep some with them, but we don't recommend keeping it all with them. We have Baird, Loomis Sales, PIMCO, and Prudential. And you see a brief summary of details of each strategy on the second half of the page. So you see they're all mutual funds except for Principal. You see various product AUM, vehicle AUM. Vehicle is specifically in the mutual funds, what's in there. So Baird has about 38 million, Loomis has 10 million, PIMCO has 45. Principal only has 141 million, which is very low. And then Prudential has 75 million in this vehicle, and our AUM in this vehicle, I should say. They're all Core Plus strategies. They're all compared up against the Bloomberg US Aggregate Index. Their approaches, you see Baird, Principal, and Prudential, they're typically fundamental managers, and they have a bottom-up process when choosing the securities in their portfolios. Loomis and PIMCO take a combined approach, so they'll do fundamental and quantitative, and they'll do top down and bottom up. Or it's more pronounced, I should say. Not that Baird, Principal, or Prudential ignore the macro environment. And then there's some key attributes. You see Baird, Loomis, Principal, and Prudential, they all highlight security or sector and security selection. Baird and PIMCO are both all considered all-weather portfolios, so no matter what, they should do fairly well, or they won't have as many large drawdowns as maybe some of the other managers. So just a brief overview there of the strategies. More importantly, though, you kind of get to the meat of it here in a bit. So page 3, it shows you where they estimated sources of value added. Baird is kind of the standout here. Most of their estimated value added is from security selection, second most being sector selection. All the other managers, their primary value add is in sector selection, with security selection being second to that. I would highlight to you that PIMCO is kind of the most balanced. They have a wider base of different value adds there compared to the other managers. Page 4.
Can you just explain security selection?
So just the individual holding. So like the individual bonds that they're looking at. That
They're evaluating those
Mhm.
bonds.
Yeah, whereas with the sector, they're looking at like, oh, industrial bonds,
okay.
Not so much tech, but more so the underlying sectors there. Page 4 shows you the top of the page shows you relative portfolio weightings compared to the Bloomberg Aggregate Index. And up means they have a higher weighting of those credit ratings, and below means they have a lower weighting. So you see most of them are underweight or have less government bonds, except for PIMCO. They're just slightly below. PIMCO is probably the most balanced. They don't tend to deviate much in credit quality. You see that Prudential has a bias to AAAs. Baird has a bias to BBBs, and so does Principal. And then Principal and Prudential have a bias to holding below investment grade assets. So below BBB is below investment grade. And then you see some more information below there. You see number of holdings. PIMCO has the highest number of holdings, so potentially the most diverse. Behind them is Baird and Prudential. Loomis and Principal have the most concentrated, the least amount of holdings. You see yield to worst there for all the investments, so that's the worst possible yield their bonds could, on average, their bond portfolio could yield. You see their coupons, current yield essentially is what that is. Average time to maturity for their portfolios. So Loomis and PIMCO have a longer maturity bias. Principal has the least or lowest maturity. Average effective duration is sensitivity to interest rates. So interest rates go up, bond prices go down. Vice versa, they go lower, prices go up. And you see that Loomis, PIMCO, Principal have a higher duration than the index. Baird and Prudential have a lower sensitivity to interest rates compared to the index. And you see their average portfolio quality on the far right there. Page 5. This dives more into the sectors that they tend to favor. Government is essentially the exact same as what we showed before. Securitized, so mortgage-backed securities, asset-backed securities, things like that. PIMCO, Principal, and Prudential tend to favor them. They have more than the index would. Investment-grade corporate bonds, Baird tends to favor, as well as Principal. And high-yield corporate, Principal tends to favor them as well. But I'd say this is the most important pages coming up, page 6 and 7. So page 6 shows you your annualized performance for all these managers going back 10 years. And the highlights here show you instances where they've outperformed the benchmark for those timeframes, and instances where they had less standard deviation than the benchmark for those timeframes, or less volatility, I should say. And I know there's a lot of numbers there, and it could take a minute to kind of formulate your thoughts. But just looking at this, I would say your top performer is Prudential, but with higher volatility. Baird, I'd say, is your second best or second top performer, but they do it with less volatility. Typically, instances where Prudential has the highest return compared to all these managers in the index, Baird's just slightly behind them, but with much less volatility. So I would say, in terms of favoritism, well, not favoritism, but I would say Baird would be your best choice, but there's more reasons why, and I'll get into them here in a moment. Page 7 shows you calendar year returns. So again, you see Prudential tends to shoot the lights out more compared to all the other managers. But in terms of just consistency, so average performance above the benchmark, Baird outperformed the benchmark 8 times going back to 2015 for all these years. Prudential did 7, Loomis did 7, PIMCO did 6, and Principal did 5. So I'd say Baird is probably the most consistent. They're not shooting the lights out like Prudential, but they're getting Prudential-like returns with less volatility. And page 8 shows you a bunch of
Do they,
Uh,
is there any place they look at the manager's duration with, because a lot of times the teams within these.
Oh, the teams,
organizations
yes.
Changed, and I saw in 2015, for example, where Loomis looks like crap, and then it seems to turn around, so is that
Hmm.
because they made
team change maybe.
Yeah.
Yeah, we have some pages on that.
okay,
So there are more deep dives into the managers starting on page 14.
but
So-
go ahead with yours, we'll get to that.
Yeah,
when we
yeah,
get to
yeah. So page 8 shows you a bunch of different risk statistics. What I mainly wanted to highlight is the chart in the top left corner. You'll see all the different managers and where they sit on the risk return quadrant chart here. Baird is the only one, and this is only for a 5-year
That's
period.
because they're in Milwaukee with Northwestern Mutual.
What?
They're the Northwest corner.
Yeah, I know.
But yeah, I'd say that Baird and Prudential are the standouts here. They're all good managers. Well, I won't say Principal's a bad manager, but we're trying to get out of there. These are all top picks: Baird, Loomis, PIMCO, Prudential. They're all top picks in the Core Plus space from Marquette, from our research team. But I'd say Baird probably looks the best. For instance, in these risks and these statistics below, they have a better information ratio, better alpha. Well, just behind alpha. Sorry for Prudential. And this is only looking at 5-year period, so don't look too deep into it. But an information ratio, sorry, is a measure of risk-adjusted value added by the manager. And then batting average is a new statistic they added. That's it's based on monthly returns going back 5 years in this instance. So anytime the manager either matches the benchmark or outperforms, that's where they're getting that ratio. So 71.7% of the time, both Baird and Prudential outperformed the Bloomberg Aggregate Index on a monthly basis going back 5 years. And then you have your up capture, down capture. Prudential has the best up capture, best down capture is Baird. If you take the difference between them, between up and down, Prudential looks the best. Baird will look the second best. Again, only for a 5-year time frame.
How much are we looking to transfer in here?
So initially we were thinking $500,000, but that cushion got bolstered quite a bit. So Tom and I were going to recommend $1 million at this time.
So question, you're talking about Baird and Principal. Does it make sense to do $500,000 Baird, $500,000 Principal, or is
Oh,
that?
no.
Prudential.
I mean,
Sorry,
Prudential,
my
I'm sorry,
bad.
Prudential.
No,
Baird and
trust me,
Principal.
I was confusing them
Yeah,
when I was going through it. You could, but it's such a small piece.
I know. That's why I was
You know.
asking, is it worth it?
I'd say probably just stick with one for now.
Okay.
Maybe once we get out of Principal, we can go back to that conversation.
Mhm.
Because we're not even gonna get half of the allocation out of Principal Core Plus at this time.
Gotcha.
But just recommending $1 million at this time. And I do want to show you the fees really quick. I think this kind of sells it here on page 10. So you see the fee schedules and expense ratios for all these managers. Baird by far has the lowest at 30 basis points.
Yeah.
Principal by far has the highest at 72 basis points. And all the others are kind of in the same range between about 0.4 and 0.45%.
So you need a motion.
Well, yeah, conversation, questions, comments on,
Well, let's,
Can you go back to the managers and just answer that question of the managers?
oh, the,
On-
on their teams?
Yeah,
They're all extremely long tenured.
okay. then forget
Yeah,
that.
they all should be pretty long tenured. I wish they put a little average down there, but years of experience for Baird, for instance, 30 to 40 or almost 50 years of experience. Years at their firms typically in the mid-20s. Years and roles, pretty high, except for a couple who are in their roles more
You can just
recent.
go to Loomis and Loomis Sales. and
Just Loomis?
I
Okay.
just want to see years at the firm.
Yeah, so page 16
Okay.
is Loomis. So their years of experience are varied.
It goes beyond that point when they had it, so that's all I wanted.
Yeah,
Okay.
yeah. Not so much based on team changes.
Right,
I would
that's
say.
that's what I wanted to say.
Yeah.
Okay.
All right, so I'm going to make a motion, Jennifer. That we take Jonathan's recommendation and move $1 million from the principal Core Plus to the Baird, is it Core Plus or Core Bond
Plus.
Fund?
Core
Core Plus
Plus.
Bond
Yep.
Fund. Is there a second?
I second it.
All right. Discussion, questions, conversations, anybody?
I mean, given our hatred of principal, does it make any sense to go above 1 million?
You do have the option to with that cushion. We could keep $1 million cushion with principal, just with volatility. I don't know how much that'll shift.
What is the recommended, I mean, what is the maximum you would feel comfortable doing?
The maximum I would say is 1.2.
All right,
at this
so
point.
let's change the
Recommendation.
recommendation to 1.2 million from 1 million.
And the general cash flow
So
comes out of the core
you-
fixed income account?
Yeah.
What?
Ellen has to accept
I,
your.
s- I
amended.
accept it. I accept it and raise it 1.
I'm sorry, go ahead, Mike.
No, I'm just,
Yeah.
the cash flow comes out of the core fixed income, not the
Yeah.
core plus.
Yeah, that's
other
why
than
you got to
that.
replenish it pretty much every meeting.
Right. So, any other questions or comments?
What's the risk that if the cushion
It's a great question.
drops,
We just push it back. We just pull it back.
how easy is it to push money back in?
You just sell some securities at Regions Bank and send
Yeah.
it. Yeah.
As long as you
Pretty
can
easy,
transfer
pretty
it
easy.
easily, the selling takes a day.
Yeah. Pretty quick.
I
Pretty
dare
quick.
them to call us out on it.
Yeah. All right, since the motion's on the table, all in favor?
Aye.
Any opposed?
No.
Perfect.
Thank you. We'll continue to revisit the cushion at future
Good.
meetings and try to continue to leg out of Principal Core Plus into Baird Core Plus.
Good. All right, perfect.
And I had the high
Anything
yield
else?
search in there if we needed it, but I don't think we need it because we
No.
already made a decision. So
Perfect. All right, anything
all we
else,
had.
Jonathan?
no, all we had.
Perfect. Thank you very much. All
Awesome. Thank you.
right.
Want me to move?
To the end?
Yeah.
I don't know if we're done.
Well, it's number 4 on the agenda.
Yeah. Do we have anything else to discuss?
I don't have anything else to discuss other than I would note that we did meet with the attorney.
Yes.
But I have not received any information back from him. But we did talk to the attorney about our ability to get completely out of principal. We've given him all the information and he is still analyzing it.
Great.
This is
So,
Victor.
yeah, I'll clarify. So when at our last meeting, I had asked permission to find an attorney because I had some referrals as a contract attorney to see, not an ERISA attorney, but a contract to see if we could try and get out of this principal contract. So the board approved that, and Darren, Jennifer, and I met with the gentleman a couple months ago, maybe. I think it was the beginning of June. Yeah, around beginning of June. And it was approved, and he is working on with somebody else to try and see if we can, what steps we could take to get out of the principal contract.
Can we,
Mhm.
my recommendation would be to also give him the information on the high yield as well. Just how they just worse spot and they decided to change it because
Yeah, I mean, we could tell him, I think it's
Yeah.
more of a contractual thing.
well,
That's-
that's contractual as well.
I know it's contractual, but I think I mean, that's all part of it, but yeah, we could tell him. There's no problem with that. Explain it to him. Yeah. So, good.
Can you share who the attorney is?
We can, but
His last name is Lassiter.
Is what?
Last name is Lassiter and
Okay.
Matt
Lassiter.
Lester. Yeah, I don't know. I didn't know him,
I don't know.
but I had talked to somebody who did some ERISA stuff and everything like that, and asked for a recommendation for a contract attorney, and that's who he recommended.
Interesting.
So,
Cool.
yeah.
Thank you for doing that.
yeah, so hopefully we are successful with that. Any old business, new business, anything else anybody's got?
Can we set the next meeting date in November? I know sometimes we have to change that.
Oh,
I think we had already changed that one.
so I have a favor to ask. Jennifer or Darren, could we send out meeting invites
Yes.
with these meetings
Yes.
like a year in advance so that not just the next meeting, but like the
least
next
they're on
3 or
our
4 meetings,
calendar.
so they're on the calendar,
Yeah.
and then we can always change them.
Yes.
We appreciate it.
Yeah.
Okay.
So I need you to remind me, when is the next
November 6th.
November 6th?
So Tom, I know, is out on the 6th, so he gave me alternative dates.
Okay.
So he gave me the 4th,
Well, let me ask you a question before you do that. Are you here on the 6th?
should be, I think.
I mean,
Let me,
no offense, but Jonathan, you do a very nice job.
thank you.
We
Yeah,
don't, I don't
uh,
think it's that complicated that we need to change everybody's schedule for Tom.
Let me just double check on that here for me.
And if anybody disagrees, please let me know.
I'm sure he won't mind. He's at another meeting that day out of town, so. Nope, I'm free.
Is anybody
So we can do the
opposed to?
Works for me.
Yeah, if we can get them nailed down at least, then I can just put a year
Yeah.
on the calendar.
It's always the first Thursday of the month after the end of the quarter.
Okay,
Mhm.
is that okay?
Yeah. I'll send them out.
We changed that a while back
And
because
don't
it was,
change it.
because we used to go back and forth like, okay, when's the next meeting? When I took over, I was like, we have to be consistent because every other committee probably is consistent.
Yes.
Yeah, I was like,
Yeah.
why isn't the investment committee or the pension committee? So. Yeah, appreciate it. All right, we'll keep it where it is and we'll get there. All right. Anything else?
And just as a reminder, I've got probably at least 2 more meetings, but
You're
once I
moving.
move, I'm ineligible, I think. So
And we will not have a going away party, right?
no, I
No
don't need
party.
motion to not have a going away party.
Wait a
There
minute.
you go.
I thought we were gonna be invited to the housewarming party.
All right, anything else? All right, motion to adjourn?
I move.
Thank you. Meeting adjourned. Jennifer, I have one. Oh, this is
5 o'clock pension.